Shalini Dharna. She is amazing. And also my CPA.
Oh, you have got my mic. Thank you. Hello, everybody. Oh, I'm not on. Can you guys hear me okay now? Yeah. Believe it or not, I can get louder, but before we get into the technical, I want to do a little activity with you guys. We're going to just set our intentions. I want everybody to close your eyes and put out a palm. And then I want you to visualize money in the palm of your hands. 5s, 10s, 20s, 100s, so much money. You need 2 hands to hold it. And then I want you to feel what that money, I want you to think about what that money feels like. Does it feel like freedom? Does it feel like relief? Does it feel like warmth on a -30 day? And think about all the things that you can achieve with that wad of money in your hands. Now slowly open your eyes and welcome. Today, we are talking a little bit technical. I am Shalini Dharna. I'm a chartered professional accountant. I'm also a licensed financial advisor, and I love money. Like many of you, I'm also an entrepreneur, so I know what it feels like to wear all the different hats and bear the burden of growing a business, hiring the staff, doing the marketing, all the things. The only difference is that I actually went to school to learn about numbers, and I hate math. There used to be a joke that back when we were called chartered accountants meant can't add. And yes, I need an Excel spreadsheet to do all my math. So I am here to help you guys understand the financial part when you receive the funding and what that means, what that looks like, and I want you to ask me questions. In fact, I am going to bribe you with candy to ask me questions. If I hit you, please remember this event is brought to you by Twainy Appeal of Canadian Small Business Women. So, why do we need funding? We need funding for a variety of reasons, whether it's startup costs like starting a website, buying that initial set of materials to create your product, hiring your first person. There's a variety of reasons why companies need funding. And do you know which gender is least likely to even go and ask for funding? Women. Women are the least likely to go and ask for funding. We think we're going to do it on our own. We're going to use our savings or just hustle and do all the things, whereas men go get the loans and they use other people's money. And yet, women tend to be more successful at business. So why aren't we using the resources available to us? Now, when you get funding, when you apply for funding, the application part is the easy part. You've got your vision, you've got your game plan, your business plan, you're forecasting $1 bajillion, and then you actually get the funding. And that's where the first set of fear tends to fall into entrepreneurs. What do you mean they actually gave it to me? Me? I was just joking. I didn't actually mean to apply for this money. And now you have the responsibility of managing that money. And for a lot of entrepreneurs, that's where the imposter syndrome starts to first creep in. I can't do this. I can't work with this. And so if you are at that stage of your finances, I highly encourage you to go back to that business plan that you wrote. What happened to that confident person just because you've gotten the funding? You also need to think about what that means for your business. What was the purpose of this funding? What was the intended use of this funding? And start kind of taking it down into small, bite-sized, actionable steps. Because sometimes the amount of funding that we receive is quite large. And that big number is what scares us. But the individual items are all actionable. And believe me, if they didn't think you could do it, they wouldn't give you the funding. So, I would be remiss if I didn't do a little bit of technical, but does anybody have any questions on the mindset part of this? Candy. Yes.
So you talked about the mindset around money and that imposter syndrome of being able to, one, get the money and that you deserve been something that you've done to kind of relearn or like reprogram your mind around money?
So the best thing you could, okay, I'm going to try. Remember, Dwayne Appeal, Canadian small business. The best thing you can do to get back into that positive mindset is to go back to your why. You started this business for a reason. You overcame certain obstacles back then to even get this idea into fruition, right? If you have a coach, a mentor, a friend that can hold your hand through this, entrepreneurship is the loneliest journey. We all think we have to do it ourselves for some reason. This is where you want to go back to your tribe and be like, I'm having a little bit of a freak out right now because I actually won that grant or they gave me that startup loan and now I'm freaking out. Say it out loud even. Journal it. Work your way through it. But acknowledge it. This is not the time to just put your head down and power through because those little feelings will creep up as you're doing the work too. So you really want to go back to that proposal that you gave the bank, talk to your friends or your team, your coach, and work through that imposter syndrome because trust me, you can do this, but you might need a little bit of guidance along the way. And that's one of the things that I offer my clients is guidance. So the first thing we need to understand when we receive any sort of funding is it taxable? Not all funding is treated the same way. And so we need to understand the source of the funding, the intent of the funding, and understand any minor criteria behind the funding. And you need to communicate this with your finance team. If you are at the stage of your business where you are now asking for funding, odds are you should at least at a minimum be working with a professional accountant so that they can make sure that your books are reflecting the true nature of this funding. Because if it's not in the books properly, it's going to cause problems later. So there's 4 types of funding. Tell me if you've ever heard of these. Debt. Anyone ever heard of debt before? Equity. Anyone heard that word before? Grants. And then founder funding. And we're going to go into each of these and talk about the pros, the cons, and what you need to understand when you are applying for each respective type of funding. And again, please ask your questions. I will throw candy at you. So first one, debt funding. This is the one women are most afraid to go apply for. And I don't understand why. Because there's actually a lot of loans and like BDC funding specifically for women entrepreneurs. But debt can come in a variety of ways. You can either take out a loan, you can get something called a line of credit, or you can just use your credit card. Now, who wants to tell me why a line of credit is better than a loan? Yes, lady in the back, blue sweater. So the interest rate is close. The interest rate on a line of credit may or may not be different than that of a loan. Does the lady in front with the green sweater want to try? Did you have a different question or answer? No?
Oh, okay. Maybe the difference between a loan and a line of credit is usually the time it takes to pay back. So loan has term, and a line of credit sort of revolving, but not like it's
Very good. So what she said, for those that didn't hear, line of credit usually doesn't have a payback term, whereas a loan usually has some terms and criteria. Do you want to come get your, you know what, we're gonna see how this goes. Nope, come see me after for candy, okay? Bigger audience than I'm, so with a loan, they usually give you all the money up front, and then they start charging you interest on it from the moment it hits your bank account, whether or not you need to use it right away or not. Whereas with a line of credit, you have access to the space, but you don't necessarily need to use it. It's there if you need it, but if you're generating enough cash flow just from your operations already, you don't have to use it. So we want the line of credit. A lot of the loans are our only choice in the beginning because you may not have enough of a credit history yet with your bank or with the lenders to get that line of credit. And then credit cards are typically your last resort. You can absolutely use your credit card to pay for expenses. The interest is still tax deductible, but most credit cards come with a ridiculously high interest rate, unfortunately. Okay? You don't need to have a corporate card for this process to qualify. You can use a personal card, but if you're using a personal card, get a separate card that is just used for business, because the interest is only deductible if you're using it for business purposes, not personal. So even if it's your personal, like in your personal name, just get a separate card. And then that way, whatever interest that card is charging you, you know every transaction is business, and you can then claim that interest on your taxes. Okay? These need to be repaid. So when you get this money, it is not considered income. And so you need to have the conversation with your bookkeeper that I am receiving funding. You're going to see a deposit in the bank, or you're going to see a withdrawal from a line of credit, so that they report it properly. Because a lot of the times, when we see money coming into the bank, we assume it's revenue. And revenue is taxable. I actually had a client who did not disclose this to me, and we were, in fact, taking all the revenue because she was an event planner, a wedding planner. So all the deposits into the account, we were considering it revenue. And then she got funding and it put some money in from her own pocket. She didn't tell us. So what do you think happened? Exactly. Her revenues were inflated by the amount of income that came from this loan when it shouldn't have been put in as revenue. There's a totally different accounting process when it's a loan. But she didn't communicate that to us, and it ended up making a bigger mistake, one that we had to fix, and it could have all been avoided by just saying, hey, I'm getting a loan. Here are my loan documents. Here is my payment schedule. Because when you have a loan, the principal is not deductible. So if you're making a payment of, let's say, $200, and $100 of that, or $150 of that is interest, and $50 is the principal, only the interest is deductible, not the principal. Any questions on debt? The types of debt, what we want to ask for. Any questions? Okay. Is it because you don't want me to hit you with candy? So debt and tax treatment, we've kind of talked about this. Loan proceeds are not taxable, interest is deductible, principal is not an expense. Then we have something called equity funding. This is when you're asking people to be partners with you in your business. This only applies to corporations. So sole proprietors cannot take on equity investors. But if you are incorporated, you can. Again, you want to be working with a lawyer to make sure that you have the right type of classes set up so that you can take on investors without giving them too much control of your business. And again, when they give you money, it's not revenue. So again, you need to be communicating with your team of, hey, I am putting out a request for investors, and I am going to be giving them X shares for X dollars, whatever your agreement is. And then the investors become shareholders. They now own a part of your business. From a legal perspective, you can adjust the control that they have. Without getting too technical, there's voting, non-voting, there's a whole bunch of legal jargon here. So you really want to understand and work with your lawyer to understand, I need their money, but I don't want to hear them talk. How can I make that happen? Are they a silent investor? Are they going to be part of the board of directors? Do they get to have a say in how you run your business? Most people hate this type of investing because they don't want to give up the autonomy of their business. And so again, equity raised is not taxable, but now you have obligations to other people. And then we've got grants and government funding. Raise your hand if you've ever applied for a grant. Okay, most people in this room. And how much fun was that? Right? Every grant has its own application, has its own criteria. It is literally a full-time job. In fact, there are people whose entire business model is helping other people apply for grants. You can get a grant writer whose entire job it is to go find you the grants and apply for those grants for you. But grants come with its own set of conditions, and you need to understand what those conditions are and how that impacts you. So, is it for a specific purpose? Are they giving you a grant so that you can hire somebody? For example, most of the cities do a summer student program. They will give you some money towards hiring a student. So that means the money needs to be used for hiring the students. Sometimes it'll be, we're going to give you a startup grant, and we want you to build a website, do this, do this. And sometimes they want you to spend your money first, show them the receipts as proof, and then they will reimburse you. So what is the conditions of the grant? Are they giving you the money first, or do you need to somehow fund it first and then just get reimbursed for it? And is there any other reporting requirements? Do you have to give them some sort of financial statement? So there is something called a compilation engagement in the accounting world. A lot of lenders require this as proof and support for the funding that they're giving you, but sometimes even grants want a set of notes behind that compilation engagement to support how their money was used. We see it a lot more in the not-for-profit sector, but it can happen even in the for-profit world. We gave you this money for X initiative. Show me how this money actually supported X initiative. And then so your reporting, your bookkeeping, then needs to be able to track that so that you can have the data. So again, this is where communication with your team, so important. Any questions on equity financing or grants? For those of you that applied, did you get them?
No.
Did they ever give you a reason as to why, or was it just no? And so there are a lot of grants out there, but as you can imagine, the competition for them is so competitive, and because you don't repay a grant, they're very particular about who they give it to. So a lot of my smaller startup clients, they very rarely get grants or funding, unfortunately. But this is taxable. So this goes to your income. But because it was provided for a specific expense purpose, usually you're not actually taxed on it because your revenue minus those expenses will net to zero. But you still need to put it into your income. Am I making sense? Like I said, finance and funding can be very overwhelming, and you just want to take a deep breath and it's all about communication and documentation, unfortunately. And so then we've got the founders funding. This is you putting your own money into your business. From a technical perspective, sole proprietors are treated very differently than a corporation. Sole proprietors, there's no differentiation between the money you put into the business and your other sources of income. By default, revenue minus expenses is all considered your income. There is no loan to the business. You cannot pay yourself back the business loan. If you incorporate, however, it is a separate legal entity. What does that mean? Well, when you had a baby, you got a birth certificate. When you incorporate, you get articles of incorporation. And it is a separate legal being in the eyes of the law. And it can have its own assets and its own liabilities. And so even though it's your business, you need to treat it like a separate person. You need to track every dollar you are putting in, every dollar you are taking out, every transaction. Have you ever heard that word reconciliation thrown at you by your bookkeeper or your accountant? That's what that's doing. It's literally taking every single number in and out and saying, okay, well, this number was from the shareholder, this number was from that person, we're literally accounting for everything. And so when you put money in and you want to do it as a loan, we need to actually show it on your balance sheet as a due from shareholder or due to shareholder, so that we can say, I put in $10,000 into the business, and you get to take out that $10,000 tax-free. Okay, so bookkeeping, super important for founders funding. You can absolutely use a personal credit card to pay for things. We just need to track it. You need to still keep the receipt, still keep that credit card statement, and we're not going to reconcile it because it's a personal statement, but we absolutely want to keep that as support. Now, fun question. Are bank and credit card statements support for CRA purposes? Who wants to take a guess? And just remember who answers so you can come and get your candy. No. So the statement shows what you paid, or whom you paid rather. It doesn't actually show what you paid. Yeah, fine, I went to Staples and I spent $80. I could have bought $80 worth of candy, right? So this receipt shows what you bought. The method of payment does not matter. It's the what you bought that makes it a business expense, not the how you paid for it. But the founder's equity part, if you used a personal credit card, the corporation owes you that money. Similar to if you ever worked a corporate job and you had to go pay for something and then you submitted an expense report for your personal, business expenses on your personal card, you can actually do that with your corporation. And I find that exercise helps a lot of people because then they get into the habit of I put this on my personal card, the corporation owes me back this money, irrespective of whether there's money in the account to actually make that payment. And so how funding should flow. You really want to put it directly into your corporate or business bank account. We don't want it going into your personal name. And you want to have a clear description of what you received. And so when you get that grant letter, usually comes with an email or some sort of agreement, share that with your bookkeeper so that they know that, okay, I'm expecting to see a $5,000 deposit. You as the entrepreneur, take your bank statement and highlight, this was funding from blah, blah, blah. Communication with your team. And again, how not to track it. Don't just record it as income unless you are positive that it's a grant, right? Debt and equity and your own personal money coming into the business, these are not income. But because a lot of entrepreneurs, especially the do-it-yourself ones, will link their bank feed in QuickBooks Online and it kind of auto-categorizes for you, well, QuickBooks is going to assume any deposits are revenue. This is why I hate doing bookkeeping from bank feeds. It's very easy to make mistakes when your business starts getting complicated. So again, you just want to make sure that you're recording it properly and do not put it in as an owner's contribution. If it's a loan, we need to show it as a loan. And again, I don't want to get too technical, but there is a difference between owner's contribution and a loan from shareholder. And if your accountant isn't explaining that to you, come see me. So again, you want to have separate accounts. You want to track the original amounts. So when you get a loan, there is something called an amortization schedule that actually breaks out how much of my payment is going towards a principal repayment and how much of it is going towards interest. Interest is them making money off of your loan. And a lot of amortization schedules, especially mortgages, take the interest up front and put the bare minimum towards your actual debt. And this comes as a surprise to so many business owners because they're like, I've been paying you like $500 a month for years and you're saying I still owe you like 95% of what I borrowed? Well, yes, because as per their amortization schedule, they probably took the majority of that payment to pay themselves first. So you want to track the original amounts, you want to track the repayments, and you want to get that amortization schedule when you first get that loan so that you know how much you're prepaying. So just to recap, loans, not taxable, equity, not taxable, grants, usually, and then if you did get a loan, so for anybody here who got like the CERB loans or back in the day, the CEBA loans, and you paid back the required amount and then they forgave the rest of it, They didn't forgive it, you just got taxed on it. And an important distinction, cash flow does not equal profit. So just because you got this influx of funding does not mean your business is profitable. And so a lot of entrepreneurs also really struggle with, how do I still function my business? Yes, you've gotten this funding, yes, you've gotten this money coming in, but that doesn't automatically make your business profitable. So we really need to be tracking all of our expense spending, tracking our sales, tracking the other elements of running our business. Some of the common mistakes that people make, they have this balance sitting in their bank account, and it's literally burning a hole in them of like, I gotta spend it, I'm gonna pay myself, and I'm going to Cuba now, or not Cuba, because we're gonna go somewhere where Trump has no influence. So the burn rate, the spend rate increases. Or your expenses grow. I can hire everybody and pay them all the money they want. You still need to be very mindful of how much you're spending and whether it's actually giving you something called a return on investment. Okay? So again, just using your funding wisely, make sure that everything comes back to a revenue-generating activity. Every single person you hire should be there to help you make more money, okay? You want to really have systems and processes to help you track everything. And the funding was there for the business, not to fund your personal life. So kind of talked about this, common mistakes, not tracking, mixing funds, or ignoring the possible tax impacts. I wanted to open it up a little bit for Q&A now. Does anybody have any questions or any kind of what they're doing in their business and how it might impact the funding or the reporting requirements? Yes.
Hi, thank you so much for the presentation. I just want to find out, can you give us like because you were talking about the ownership contribution versus like from teaching levels. Can you just like give it a short explanation?
Absolutely. So the question was, what is the difference between an owner's contribution versus a loan? So owner's contribution is the value you're putting to your share, the share of the business. So did I buy this share for $1 or did I buy this share for $100,000? You're only going to be able to recoup that amount when you ultimately sell your business. And so if you put that towards the share amount, you're going to have a lower, what we call capital gain, when you eventually sell the business. Whereas a loan, shareholder loan, is me giving the money to the business, and I can take that out tax-free anytime I want. So it's the return to you that is different between owner's contribution and a loan to shareholder. Yes?
Is one of the services you offer discussing the mindset you need to have in order to go the equity funding route? You mentioned that you have to kind of, because I'm very type A as well, I don't want anyone touching my business. So I think where I need the support is helping me understand like what the benefits are besides just the cash.
Yes, so one of the things I do offer is a clarity session, which is basically a half-hour Q&A on your specific items. But a lot of the time, that particular conversation also needs to happen with a lawyer who can explain to you the different share classes that your corporation has allowed. Now, fun fact, if you did this on owner by yourself and never actually came up with articles and minutes and all that stuff, right now your corporation doesn't have any of these rules. So it might be easier to set up the different types of shares if you've never done that. But if you've already set the stage and you've already done that initial share class structure, then we definitely need to get a lawyer involved to possibly issue some new ones. But yes, I do offer clarity sessions to help people walk through those problems. Yes?
Hi, thank you for your presentation. I'm new to the area. I would like to know at what stage of service-based business does qualify for funding here in Canada?
So you can get a startup fund. You can absolutely get it before you even launch. The key, even in a service-based business, is understanding what are you asking money for. Most lenders want something tangible to back up. It's not, generic, I need to build a website, I need to take some courses, what do you need? The biggest mistake startups make, especially service-based, is they use all of their money, and then they go and be like, I kind of spent all of mine, can I have some of yours? Lenders don't like that. But if you can go to the bank or go to BDC and be like, I am investing 10,000 of my dollars into this business, and I would like a loan for ABC purposes, you're more likely to get a loan because they're seeing that you've got skin in the game, as opposed to, I've already used all my money, now I need yours. Yes, in the back.
Hi. So, in terms of loan versus grants, based on what she said in your response just now, is it the same aspect if I was supposed to apply for a grant? Do I have to have like 10,000 of my own money ready to go to show that I need the grant for such and such purposes?
No, a lot of the grants don't require you to necessarily have money available to use into the program. It very much depends on the grant. Every grant has different criteria. Some grants need you to be in business for X number of years before you qualify. Some are for brand new startup funds. So there are grants available for brand spanking new startups like Fempreneur, Startup Canada. They all do a lot of grants for like brand new to business. And to my best understanding, they don't require you to have X dollars already set aside for the business. But again, they change their criteria every time they issue new funding. So you just have to be aware. Like I said, it's a full-time job applying for grants. Do I have time or? Okay, last question. Yes.
So when you asked the audience the question about grants, who had gotten grants, and some people mentioned, and you asked what was the reason why it was declined, a lot of people said they didn't know. Is there an avenue where people can learn why their grants were refused or what they can do better?
I asked the question, but as I expected, majority of people never got any feedback as to why they were declined. So unfortunately, there's very little feedback that gets given to grants. It could just be a matter of you had a great proposal, but whatever that initial filter was, maybe they were just throwing darts and you just didn't hit the board. Like, there's no requirement for them to give you any criteria. With loans, oftentimes if you are declined, they will provide you with a little bit of feedback. We did not like your projections. Your own credit score is not that great. Unfortunately, sometimes your own personal credit score gets factored into funding that the banks want to give you. And as much as at one point when you had a corporation, you could get a loan and it would be separate from your business or your personal assets. What I am finding more and more, especially post-pandemic, is that loans are requiring a personal guarantee. More and more of the lenders are saying, even if your business fails, you are personally guaranteeing the loan, which then means if you can't pay it back through the corporation, you are still personally responsible to pay back that loan. So loans, I tend to see people get a little bit more feedback. Grants, not so much. Okay, well, thank you so much. I do have some information down here. If you are interested in learning more about me, follow me on Instagram. And for those of you that want candy, I will give it to you gently in your palms.